Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. Now, the basic drivers in the recent past had been the same here for many months, driven by the same key patterns. They are the October 2020 to March 2021 bullish shift pitchfork, notably the upper time currently at 23,895, and the more recent November to December 2021 bullish Andrews pitchfork, notably again the upper time currently at 24,510, and also the middle time currently at 23,000. Both these pitchforks had been broken previously, but I kept them on the daily chart because they still worked. Indeed, I was inclined to view both breaks as substantial breaches and not full breaks. Well, that idea of breaches compared to breaks is once again being tested as both upper times have been breached over the last few days. All these tests higher can be traced back to the initially to the big, immediate countering monthly key reversal up made back in October last year, and the subsequent late June 2021 to January 2022 really big diamond continuation pattern. Recently, the market has utilized the more acute middle time of the bullish Andrews pitchfork to move higher, something I thought might be unsustainable. However, here we are with new high territories not seen since 2011. The question now is this breach higher going to turn into a break higher, and where next is the resistance? Well, this latest move higher happened because of the bullish engulfing pattern made on Tuesday last week, and it does look as if it has some legs on it. The resistances start now, roughly from where we have peaked today in the 24,885 area up to just over the August 2011 high at 25,250. We then have a clear piece of air up to the resistances at 25,885, 26,750, and then the May 2011 high at 27,325. However, there is one other pattern that might be guiding this market higher. It is the January-based bullish shift pitchfork. This one is a little more acute than the bullish Andrews pitchfork, but it is substantially intact, having only one small breach in it early last week. Right now, the market is just coming up to the middle time, and that's currently at 25,090. This is one to watch. LME 3-month zinc. Since the fall down the far side of the mountain in mid-October and early November, the market had gravitated towards the broken uptrend of the old May 2020 to date optimized uptrend, currently at 35.33 that I'd kept on despite it being broken, as it has given a pretty good account of the bullish angle of attack of this market. Assisting and running parallel to this uptrend has been the rising short medium moving average, currently at 35.24. This optimized uptrend had shown the bullish angle of attack for many months until it stopped working correctly in early October 2021. Since the move down the far side of the mountain, the market had then reacquired it, especially since prices cleared the congestion at 33.02 and between 33.02 and 33.66. This it did in mid-December last year, and more or less immediately started a fresh bull channel, currently at 36.63 to 38.29. This worked until last week. Why did it stop? Well, I gave the answer last week. It was the impact of the rising market up and into the middle time, currently at 37.41, of the early October to early December 2021 bullish shift pitchfork. This middle time had capped the market despite being breached a few times. And despite it being a bullish time, it has apparently been the new driving force in moving prices lower. Now, I had warned about this for some time now, but I thought it would just deaccelerate the rise rather than cap it properly. The break lower has this week ventured below the February 2018 high at 35.95, and today has seemingly had second thoughts because of something I mentioned earlier. The support provided by the combined May 2020 to date optimized uptrend and its partner, the rising short medium moving average. Now, this doesn't mean that these two are invulnerable, but it is worth considering as support. Just in case they get broken, Then below we have two further key supports to consider. The 50% Fibonacci line of the big October 2021 move at 34.77 and the rising medium moving average currently at 34.22. These two are separate right now, but with the rising medium moving average it would not be long before they intertwine, and the sum of their supportive natures will be greater than their individual supports. In short, the market needs to look to hit them before the end of next week, it seems, to gain the optimum bearish traction. Otherwise, it may just be a little bit too late. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.